I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers Podcast Show, and today is Monday, August 29th.
And this is your interest rate update.
If you're new to the channel, be sure to subscribe, comment, and like. We do this Monday through Friday. And remember, this is for financial advice. Sorry, this is informational purposes only, not financial advice.
That's right. We're not your financial advisors, but we hope to be your mortgage broker. So here we go.
Okay, 30-year fix today we see at 5.32%, a little bit higher than Friday. 15-year fix at 4.75%.
The 30-year FHA about an eighth higher at 4.875, and the same with the 30-year VA, 4.875.
These loan assumptions are right here for conventional FHA and VA. What I mean by loan assumptions is we are assuming this criteria right here for you. If you were a borrower with a primary residence, your credit score was over 740, you had a loan amount at $400,000, and you had 25% down, you could get that conventional loan interest rate.
Yes, I mean there's four big variables. Number one, what type of a home is it? Primary or rental. Number two, what is your credit score? Number three, what is the loan amount? You know, it changes. You know, a $50,000 loan amount compared to $1 million loan amount, and then what is your down payment? What's your loan to value going to be after the money you put down on this home?
So there's no extra fees, no points to get these interest rates. A lot of banks and people, I know we say this every day, but we're mortgage brokers. 90% of the banks that you'll call, and I mean a lot of people think they're calling a mortgage broker, but they're just calling a correspondent bank. Basically, your 90% of lenders are going to have higher rates. They're going to be charging points, which are extra fees.
Yeah, and they have a limited amount of loan pools. I don't know if that's the technical term, but they have a limited, box to choose from in terms of what loans they're providing their borrowers. For the mortgage broker, we go to the wholesale platform, which we have all these different banks out there that are just, lending money on a wholesale basis.
That's right. I want to show kind of a big picture for 34 years, since 1988 to today. People have always asked, where are interest rates? Like, where are they going? And in order to, I think, see where they might be going in the future, let's look to where they were in the past. And if you look in the last couple years, you might think, well, I don't see any sense of direction. But this is 34 years. We can all clearly see these green lines, these slides coming down. Those are lines that I put in that chart so I can kind of show everybody now this is the 30-year bond. This is not the 30-year fix. It actually looks very similar with the 30-year fixed mortgage. But I'm showing you this because the bond market is what determines or really affects the interest rates. We have been in a downwards, straight down from 1988 to today. And the answer to why is this the case? Why are we seeing rates coming down? Why are bonds cheaper? Why are rates continually going down over the long term?
Right. Well, and this perspective is amazing. It's almost 25 years, we said, right?
No, 34.
Okay, almost 35. Okay. So basically, you could look at that in a microscope. Well, I guess in a broad base, you'd be like, well, that's really, far off data. How am I able to understand it? What does that mean? But when you look at most things in life, a lot of what we do is we go off of patterns. And if you were to call someone and say, hey, how long have you been in business? And they said, 5 years, versus someone being in business for 35 years, you'd say, that 35-year person has a lot more experience. There's a lot more there that I can actually rely upon. And this data, that's huge. 35 years of this trend. Yeah. That's not an accident.
Yeah, and to say, this trend is going to change right now.
But yeah.
I mean, we have just broken through. But the problem is we have inflation. The reason why this has been going down is because the debt is increased. And this is globally too, right? Globally, we've seen debt increase. In order for the debt, like those interest payments that the countries are paying on that debt, they have to have lower interest.
Yeah. I would say countries are like people. They have behaviors. Depending upon who's in office, that behavior changes a little bit. But countries have behaviors, and this is what our country has been doing in order to keep the market and its economy doing what it is doing. Again, there's far too much, to
Yeah.
try and dissect this. But this is a big pattern.
Yeah, and I just want to make sure everyone can see that we do believe, even though we're at interest rates today where they're at, we believe in the next 24 months we're going to be going back down. I mean, I feel like the eventually will happen, and again, a lot of analysts are seeing that we're going to have to, in order to make this affordable, we're going to have to, the Fed will eventually pivot and change their tone, lower the Fed rates. We'll see mortgage rates, all interest rates come back down. We're not there yet,
right?
But they're going to, I think, coming back down here long term.
Right, and the key word there is, I think no one knows the future. So if you're in the home buying or you're in the refinance market right now, like, I just don't know what I should do. Our general advice is from a primary home. This is on a purchase on a primary home basis. Do not time the market. It's not timing the market. It's time in the market. You will see ups and downs, hopefully for the next, not hopefully, but for the next 50, 60, 70 years, however long you are a homeowner. These rates, when they come down, we simply would refi you at that point. Similar to if you're in a refinance mode right now and you need to pull some money out to do some, some cash out, pay off the pool, pay off the credit card, pay off student loans, pay off, XYZ debt, you can always lock in on that fixed rate. And if they go down, we simply refinance you. Again, the refinance is not a way for us to make more money, but all we're saying is that you can lock in that interest rate today because they may not. I mean, there's a chance they don't go down, right? I mean, we don't.
Yeah, all things are possible.
We don't know. So you lock in on that 30-year fixed, and then as rates do come down, because we do think that they will, then we simply, catch that rate as it keeps going down.
Yeah. We'll be back tomorrow with another interest rate update. Be sure to subscribe, comment, and like, everybody.
All right. Thank you, folks.
Thank you, everyone, for watching our show today. If you have questions, be sure to email us at rates@azmortgagebrothers.com, and be sure to take a look at all of our other videos on our channel.